Let's jump right into this explainer. If you're a BAccS or CTA student, or you're gearing up for those crucial SAICA board exams, listen up. Today, we're totally demystifying the remaining Section 10 exemptions of the South African Income Tax Act. Mastering these specific rules, that is literally your ticket to flawlessly tackling those massive, integrated tax scenarios. So let's get into it.
We've got a pretty packed syllabus to get through today. We'll kick things off with a fundamental tax formula, then cascade through some high-yield topics like non-resident interest, foreign employment, and bursaries. After that, we'll hit those minor exemptions and wrap the whole thing up with a critical breakdown of exam technique.
All right, Section 1. Let's look at the exempt income formula.
Okay, so your golden rule here is super simple. Gross income less exempt income equals income as defined. The main thing you've got to remember is that exempt income is absolutely shielded from normal tax. It's like an impenetrable fortress. Examiners absolutely love testing the boundaries here, you know? They want to see if you know exactly when to protect an amount and when you have to expose it to the tax net. Moving right along to Section 2, non-resident interest under Section 10(11)(h).
Now, here is a classic examiner trap. Generally speaking, non-resident interest is fully exempt. The government does this to encourage foreign investment, right? But beware of the permanent establishment, or PE trap. If a non-resident entity, let's say Oliver Capital Limited over in Australia, earns interest that's effectively connected to a South African branch bank account, bam, that exemption completely falls away and the interest becomes fully taxable. No exceptions.
But wait, there actually is a bit of a lifeline here, and it brilliantly illustrates how the legislative hierarchy works. Let's say an individual fails that Section 10(11)(h) test, maybe because they're receiving the interest as a fixed annuity. Don't panic. They might still be able to fall back on the standard Section 10(11)(i) domestic exemption. So the rule of thumb? Always test 10(11)(h) first, and then look to 10(11)(i) as your safety net.
Check out these basic domestic interest exemptions, R23,800 and R34,500. The massive trap here that catches so many students is apportionment. These are annual maximums. To put that into perspective, if a 30-year-old taxpayer emigrates or passes away exactly 100 days into the tax year, you absolutely cannot just grant them the full R23,800. You got to do the math. You apportion it, 100 over 365 days, multiplied by R23,800, which leaves an exemption of just R6,521. Please, whatever you do, never miss that step when you're under time pressure in the exam room.
All right, Section 3. Foreign employment income under Section 10(1)(oo)(ii).
To exempt remuneration for services rendered outside South Africa, you have to apply this absolutely ruthless and test. The employee must be outside SA for more than 183 full days in any 12-month period, and that period has to include a continuous absence of more than 60 full days, and the services have to be rendered for an employer. Miss even a single one of those requirements, the whole thing collapses and the entire salary or bonus becomes fully taxable.
But you've got to remember this sneaky little transit proviso. A person in transit through South Africa who doesn't formally enter a port of entry, like they don't clear customs, well, they're deemed to still be outside South Africa. So picture a layover at OR Tambo Airport where they don't go through passport control. That won't break their continuous 60 days. You really have to keep your eyes peeled for this one in scenario questions.
Let's move on to Section 4, Bursaries and Scholarships under Sections 10(1), Q, and QA.
The foundational rule here is completely non-negotiable. It has to be a bona fide, genuine scholarship for a recognized educational institution. The whole point of this legislation is to prevent disguised remuneration, so it must never represent a salary sacrifice. If an employer is just relabeling a portion of a regular salary and calling it a bursary, that exemption is dead on arrival.
Now, if you actually pass the bona fide test, your next focus is this magic number, the R600,000 proxy limit. For a relative's bursary to be exempt, the employee's remuneration proxy for the prior year simply cannot exceed R600,000 Rand. If they earn even a single Rand more than that, boom, the relative's bursary becomes fully taxable as a fringe benefit.
Okay, so once you're safely under that R600,000 proxy limit, you cap the exemption based on the actual qualification level. For basic education, which is NQF 1 to 4, you're limited to R$20,000. For higher education, NQF 5 to 10, the limit jumps to R$60,000. And just a quick side note, always remember that Section 10(1) QA specifically offers much higher limits to incentivize education for persons with disabilities. Keep that in the back of your mind. Let's actually run through a quick exam scenario to see how this works. Let's say Tamosha's son receives a 75,000 Rand bursary for an NQF5 qualification, and Tamosha's proxy is well under R600K. How much is exempt? Well, the examiner wants to see if you know how to apply the cap. Because the NQF5 limit is strictly capped at R60,000 Rand, only R60,000 is exempt. That remaining R15,000, that has to be included in her taxable gross income. It's simple, it's highly mechanical, and it is absolutely going to be examined.
Moving into Section 5, Minor Employee Exemptions.
Okay, these are your rapid-fire one-line exemptions that you absolutely need to have in your toolkit. First up, work condition exemptions. Section 10(1) NA exempts uniforms, provided they are a strict condition of employment and clearly distinguishable. Think of hospital scrubs with a big medical logo on them, right? We also have 10(1) NB for employer-borne relocation benefits, plus Social Security exemptions like 10(1) NB for UIF benefits and 10(1) GC for qualifying foreign pensions.
You also need to be able to instantly spot specialized exemptions so you can shield them from normal tax. I'm talking about things like Section 10(1) for alimony, non-resident royalties, and foreign entertainers. And crucially, whatever you do, don't forget the social welfare exemptions. That's Sections 10(1) through GB, which cover war and disability pensions, funeral benefits, and the Section 10(1) employment tax incentive. The moment you see any of these in a scenario, exempt them immediately.
Let's bring it all together in Section 6, Tackling Exam Questions. You want to follow this systematic 4-step approach every single time to guarantee maximum marks. Step 1, start with the gross income inclusion. Step 2, aggressively test the specific Section 10 legislative requirements. Step 3, double-check for any sneaky exceptions or apportionments. And Step 4, calculate your final exempt amount. Presenting your answer with this kind of logical flow makes it incredibly easy for the examiner to just throw marks at you. As a final revision checklist, let's look at the absolute top examiner traps. For non-resident interest, you always want to be hunting for permanent establishments. For foreign employment, ruthlessly apply that strict and test. And for bursaries, always verify that R600K proxy and the NQF limit before you grant a single Rand of exemption. So as you head into your final prep, you really need to ask yourself, when you sit down and face a massive integrated gross income scenario, will you be the student who falls for those hidden traps, or will you be the one who systematically shields every possible Rand from the tax net? Trust your frameworks, practice these scenarios over and over, and go a step deeper. Thanks so much for joining me on this explainer, and happy studying.